Hi, everyone. This is Jason Bierk of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. I like having them on every couple months. They are one of the top financial writers over on Substack, our favorite green chicken on financial Twitter, and way ahead of the curve on economic analysis. They are looking for things that might play out over the next 12, 18, 24 months with calls about the fertilizer crisis, diesel crisis, and others way ahead of everyone else. Team Doomberg, thank you for joining me again.
Jason, hope you're having a great start to 2023. Thrilled to be back and looking forward to another robust discussion.
Great. Well, there's always lots to talk about. I mean, the main thing going on now with financial Twitter and a lot of these experts on there with large accounts, other than you probably, is they're saying that inflation has peaked. The Fed's going to continue to raise interest rates. We're recording this interview on Tuesday, January 31st, 2023. For our listeners out there, the dollar index is at 102. We've had a little lull in energy prices. So what are your thoughts on inflation and if it has peaked?
Yeah, great question. And I think as we were chatting about briefly before we hit record, I think that the inflation numbers reported by the government have certainly peaked. We're seeing changes in calculation methodology that are about to hit in February of this year. And additionally, it must be said, to be fair, the year-over-year comps are getting much harder. Used car prices are coming down, as you mentioned in your opening statement for that question. Energy prices have come off their highs. And so I would say for the people who follow what the government publishes, I think we're going to see CPI come in pretty solidly throughout 2023. We just had Steph Pomboy over at Macro Mavens on for our Doomberg Pro webinar in January. She's a brilliant thinker. And just doing the simple math based on the comps and the changes to the way the government has decided that it's going to report the CPI index, she expects reported CPI numbers to get down below 4 and ultimately 3, maybe even as low as 2% this year. We wouldn't be surprised by that. I would contrast that with my own personal experience, and I'm sure your similar personal experience. Anybody who's traveled in the past 3 months knows that that inflation seems to be wildly out of control. But to the particular question of what CPI numbers will print and how Wall Street will react to it, we would firmly be in the camp that at least for 2023, the numbers that you'll see parading around on CNBC, reported in the Wall Street Journal, and tossed around on FinTwit will be that CPI will be measurably lower in the next 6 to 9 months.
And you have, I think that's an interesting point you brought up. You have government economic data, which is saying one thing, and then you have reality, which is saying something else. So if you're traveling, you own a small business, you consume a lot of items, you actually pay attention when you go shopping at the grocery store. So if you're actually measuring things like cost per unit, unlike the PhD economists here in the Washington, D.C. metro area that work for the government or a think tank or a government agency or an economic consulting firm or work up in Wall Street they're not actually paying attention. I don't know who does the grocery shopping for them or who goes and buys their consumer items at Target, Walmart, the grocery store, Costco, or something like that. They're just not paying attention to cost per unit. So if you run a business or you're shopping, the cost per unit, you're getting less for more currency. So you're paying more dollars or more euros for less stuff. So that's what cost per unit is.
I'll give you an anecdote. So I recently traveled to a city in the South to speak at a friend's conference. And one of the things I like to do when I check into the hotel is I head down and buy, enough bottled water to get me through the trip. And there was a little coffee shop there next to the lobby. And sure, you're in a hotel and you have to expect there to be some markup. I bought 3 relatively small bottles of water and an Americano, and the bill was $24. It's one of those little signposts in life where you're like, huh. And by the way, it didn't totally shock me. Like, it just, that's the price you pay now. And so, I'm old enough to remember when $24 was a healthy chunk of my grocery bill. And to get 3, small bottles of water and an Americano for $24, albeit in a hotel lobby, it still sort of struck me as a pretty interesting signpost for how far we've come. And I doubt that a bottle of water costing, I guess, $5, probably $6, I guess, is the official representation in the government reported CPI index.
Well, it doesn't count things like insurance. I mean, insurance costs for a lot of people for car insurance and other types of insurance are up enormously. I'm just seeing people tweet about this stuff. So yeah, used car prices are down, but a lot of other prices are up enormously that are not being counted. Things that people use every day to run a business or manage their family expenses.
Yeah, and again, I think the comps will get a little easier, and I think again, one of the things that we've learned over time is that markets move based on a whole different set of reality to everyday living, right? And the quicker you could recognize that, perhaps the more money you could save yourself. One of the reasons why we rarely trade in the markets ourselves is just because we live in a world that is so orthogonal to the way things are presented in popular media that it's very difficult to break through that noise and get to the signal. But to the original question, I would be shocked if CPI reported numbers do not come in sharply in the next 2, 3, 4 months, and every time they're reported, the market will rally. Relief rallies. We're seeing in the first few weeks of January here a real spike in what we would call shitcos. All the sort of fraud stocks and the companies on the verge of bankruptcy are rallying 20, 30, 40, 50%.
You think that's short? You think that's probably short covering though, too, not just the market guessing that the Fed's going to stop a cut on the interest rates.
I don't know anybody who's short these names in any material size. Shorting is a terrible way to make money, and if you look at some of the names that have rallied, that the short interests aren't really all that spectacular. And the floats on some of these names have grown to the point where it's difficult to pin it on short covering. I just think I don't dismiss market action lightly. And part of me wonders whether this isn't sort of the early signs of when inflation reemerges, because ultimately we are on a sort of unsustainable debt glide, and the debasement of the currency, which, with the refinancing of U.S. government debt going to juice the interest payments, all the things that people have been warning about for years, we're sort of sleepwalking into this. And I wonder whether, far be it from me in particular to say the markets are wrong. I wonder whether this isn't sort of getting ahead of potential sort of a renewed robustness in inflation on the back end of the year as the full effect of China reopening and oil prices perhaps creeping back up because of the end of the Strategic Petroleum Reserve releases. Maybe it gets a little cold in Europe. And so I observe the markets. I view them with some interest. I rarely participate in them. There's something going on. The market doesn't believe that Powell means what he says when he's going to consistently, rate hike. We'll see. I mean, we have a Fed meeting, I guess it is tomorrow, and that'll be a pretty interesting tell, both the decision and the press conference afterwards, as always.
Well, I think the Fed's almost definitely going to raise interest rates. The question is if it's going to be 25 basis points or 50 basis points, and what type of guidance they're going to say for future rate hikes. So there's educated guesses that they'll do a quarter basis point rate hike tomorrow, and then they'll do one more quarter basis point, but they're not going to quickly cut rates unless we start to see in the headlines that there's banks or insurance companies failing or some type of panic that actually hits the headlines, maybe a Lehman Brothers type of event. Although in this case, I think unfortunately, the policymakers in governments and central banks, they learned the wrong lesson from letting a bank go bankrupt, letting actually Lehman Brothers fail. A lot of them have said post Lehman Brothers that the mistake they made was actually letting Lehman Brothers go bankrupt.
Yeah, well, also I wouldn't, get too myopically focused on interest rates. The Fed has a lot of tools, and the Treasury has a lot of tools. Just the repo stuff and the reverse repo, there's a lot of liquidity sitting there. You have quantitative tightening and how fast the Fed allegedly is going to shrink its balance sheet. And so there's all manner of ways that you and I can't conceive here until they become apparent that the federal government can achieve its policy objectives in the financial markets. And a case in point would be a year ago, Joe Biden decided he wanted lower gas prices in the United States. And by hook and by crook, he was able to do that well ahead of the midterm elections. And so, as a general rule, you don't want to fight the Fed. And I know that's kind of a bit of a well-worn and well-beaten phrase at this point. But you don't, if your counterparty to your trade is Joe Biden's desire to achieve a political objective, he probably has more money and more tools than you to achieve that objective. And you should at least be aware who's on the other side of that trade.
Well, you also have on the other side, you have the Saudis and OPEC, which is a cartel counterbalancing that. So there's ways that they can do too to manipulate the market, or they can pull oil supply. There's things that they can do too to offset that. So that's why oil prices haven't crashed either, is because there's been also production cuts from Saudis and OPEC over the last, 8 months.
Yeah, they have a different objective, though, than, say, an oil speculator in the US. They want price stability well above their cost of production. So I would propose that if you offered OPEC the deal of $80 Brent for the next 5 years locked in, they would take that in a heartbeat. And so I
agree. I actually made a video about this years ago. Don't know if you saw it. I called it the Goldilocks oil price scenario. It rarely stays where the oil price is not too high and not too low, because if it's too low, the producers don't make money and they go bankrupt, and then there's supply problems. But if it's too high, then you start to see politicians talk about windfall profits taxes, and then all the alternatives to oil start becoming economic then. And that kills demand.
Exactly. I agree sort of with most of what you said. I mean, it's of course, like everything in life, there's probably a bit more nuance to it, but they are not in the camp of celebrating $150 oil, because that would mean economic contraction. That would mean, as you say, pressure to find substitutes, political ramifications. At $80 oil, the Saudis are making an awful lot of money, and they'd be just fine with that, because at $80 oil, very few substitutes are economically competitive. So yeah, I think that's pretty true. And so if on the one hand you have Joe Biden desperately trying to bring prices down, and on the other hand, OPEC kind of trying to put a foot under the market, it's hard to be super bearish in that scenario. Super bullish in that scenario.
Yeah, so I think for the next at least 2 or 3 quarters, I think oil could be somewhat range bound. I don't think we're going to see necessarily oil potentially crash, because I think we could see OPEC and the Saudis announce production cuts. If oil starts to get weak in this environment, they'll just come up with excuses. But there's been interesting comments in the last week to 10 days from the Saudi oil minister. He's basically said that if China comes back online, if they reopen their consumer economy, they start traveling more with airplane flights, with jet fuel, they start reopening the factories, that almost all of the spare capacity will be gone very, very quickly.
Yeah, and that's the sort of great unknown in 2023. And I caution every time I speak about China on a podcast that most Western analysts have very limited insight into what's actually going on in China. I suspect the Saudis have pretty good insight into what's going on in China. And based on our contacts in country, and we have several friends, predominantly in Shanghai and Beijing, the bit flip towards going from a dynamic zero COVID policy to COVID no longer existing was really pronounced, even for people that are experienced with propaganda shifts within the country. And so I do think that once, and by the way, there are very strong signs that the COVID wave has already crested in the cities. Much more difficult to find out what's going on in the rural areas. But in the major cities like Shanghai and Beijing, life has returned completely to normal. And we know how this plays out. We've seen it happen here. There's going to be a boom in sort of leisure spending, and all that pent up savings is going to get spent. And once we get through the supply chain hiccups that come with a bunch of people being sick and missing work, it's no coincidence in our mind that they relaxed the COVID policies just ahead of the Chinese New Year, when everybody was already traveling and things were shut down anyway. 2-3 weeks, vast majority of this stuff is over, and life goes on. And I think, one thing that it does show is that the Chinese Communist Party, while they do run a surveillance state, they do also care very deeply about social unrest and instability. And when we saw those protests break out, where highly unusual people were specifically calling for Xi Jinping's resignation, that really, I think, shook the CCP into action. And I do think if we see a full Chinese reopening in 2023, that could be the spark of an inflationary pulse in the back half of the year, once we get through these sort of tough comps and the CPI massaging that I expect the federal government to do.
So I want to ask you about profitability for these oil and natural gas companies. Chevron and ExxonMobil had record profits in 2022, along with the other big oil companies, from higher natural gas prices. They had a relatively high oil price. Do you think then that inflation and higher costs, that it's going to put a higher price floor in oil and natural gas prices going forward? It's basically the thesis that hedge fund manager Harris Kupperman, aka Cuppy, has laid out, that with higher energy prices and the lack of investment on the supply side, that there's going to be a new normal, a higher price floor for energy prices going forward.
I agree with Cuppy. I would say, again, if you look at some of the other commodities that have come off, sort of blow off top highs, like a classic example I think we're going to see is semiconductors this year. There has not been the capital expenditure response that you would typically see to the high oil prices we have observed in the past 12 to 18 months. That's for a variety of reasons that we've discussed on previous episodes, and most importantly, choking off financing for the oil and gas sector because of the ESG movement. If you just look at the capital expenditures of the publicly traded big oil companies as a good proxy for the industry, it's still less than half than what it was in 2013 and below maintenance, basically. The two numbers to watch are U.S. oil production, which is flatlined at 12 and looks to be rolling over. And of course, SPR releases, which seem to be drying up. And so don't forget, for basically all of 2022, the U.S. produced oil at 1 million barrels a day lower than they had pre-COVID. And the U.S. Strategic Petroleum Reserve was being rated to the tune of, you guessed it, 1 million barrels a day. And so for political reasons, the Strategic Petroleum Reserve was used to paper over a production shortfall in the shale patch. I don't see how we get to production increases in the shale patch this year, given the combination of reduced capital expenditures, fiscal discipline on the part of the oil and gas producers, and, as we know, the rapidly depleting wells in the shale patch that require consistent new drilling that just isn't there. I don't know how we increase shale production, and absent sort of complete draining of the Strategic Petroleum Reserve, we're going to finally have to reconcile what a world looks like where, the source of 90% of oil's growth in the past decade is no longer there. And China is finally coming back into the global economy when it hadn't in the sort of year and a half after the rest of the world did.
And the growth plans that Chevron and ExxonMobil are announcing, where they are making some CapEx investments, are over 3, 5, 7 years, sometimes even 10 years. So the growth to increase oil production by 10 or 15%, it takes billions of dollars of investment, and it's not going to happen in a year or two. It's going to take at least 3 to 5 years. I think that's what their growth projections, but they're spending most of their CapEx right now, Doomberg, with their enormous profits and free cash flow from 2022, it went into dividend increases and share buybacks. And that's probably efficient right now when politicians are threatening to increase windfall profits taxes. And then in the Biden administration, there's tons of problems with getting leases for oil and natural gas drilling.
Yeah, again, I think a lot of those big number headline grabbers are basically just managing the politics. When you're announcing record profits, and the president is tweeting and his spokespeople are speaking from podiums, lambasting the industry for not doing enough to lower prices, even though prices are well off the highs and amongst the lowest in the civilized world. It's natural to sort of put out those types of headlines. But as you say, these are big battleships that take a long time to turn. You have permitting issues. You have local legal lawsuits and all of the red tape that these companies have to cut through. It's a miracle that they produce at the rate that they do. But I don't see huge production response to the elevated prices we've seen in the last 18 months. And if that's true, historically, the boom bust cycle in all heavy commodities happens when people start drawing what we would call tangent lines to sine waves. And in this instance, we have not seen the typical overproduction, overinvestment, coming online all at the same time and crushing prices just when everybody thinks the good times can't ever end. And so I do think, and we've seen that there's basically kind of an $80 put. I know Raoul Pal was out on Twitter claiming that we'll soon see $40 a barrel or $60 a barrel. And Jared Dillon was saying, if this triggers you, you're a little biased. Those things all might happen. In a world where
maybe temporarily, but what's the South? I mean, the Saudis are the low cost producer, but aren't their costs closer to 30, 40, 50? They're not $20, $30 a barrel to produce oil anymore.
Well, I would just say, in a world where oil is trading for $40, you've got much bigger problems than the price of oil, because that means we've had an economic slowdown of profound consequence, and that might be on the board, and that might be what Raoul sees in the charts, and I hope he's not right. Not because I'm pro high oil prices, but because I'm pro reasonably good growth economy. But if we see $40 oil, $30 oil again in this environment, it means that we have a severe recession that nobody sees on the radar.
So I want to transition now. You talked about boom and bust. I want to talk about natural gas prices because in the last 8 weeks, we've just had a roller coaster. I mean, natural gas prices were, I would say, too high for liquefied natural gas in Europe. And then the US natural gas futures contract, I think, got to about $8 for a good amount of time months ago, 4 to 6 months ago. And then even 8 weeks ago, I think it was still around 7, give or take. And now here we go 8 weeks later. It's at $2.67 right now when we're recording this podcast interview. It seems to, and then I've been looking at production cost estimates for the industry, and it looks like production costs, there's not a lot of cheap natural gas available. There is a lot of natural gas. It's just not cheap anymore. And it looks like the costs, Doomberg, are going to keep rising. We just had an earnings call last week with the quarterly results from the largest oil service company in the world, Schlumberger. And they said that they're going to be raising prices substantially again for completing wells and other oil service parts of their business. So it doesn't look like the natural gas industry. I know a lot of the producers are hedged for at least 12 to 18 months at 6 or 7. Some of them locked in their hedges when natural gas prices were high. They rolled over their hedges at higher. But what do you think in a scenario here where the cost of production I've seen for some natural gas producers is at 4.9? I don't know if that's accurate for the entire industry, but that was one of the estimates I saw. Now we have a natural gas price that's way below production costs at 2.67.
Well, the great frustration with natural gas producers in the U.S., of course, is that there's a whole swath of quote natural gas producers who are actually producing oil and getting associated gas as an unwanted byproduct that at some times, they actually pay people to take away. And so I would say that the marginal producer might be losing money today, but there's a whole swath of quote unquote energy producers who produce oil and get associated gas as a consequence of that oil production. Now, you've had a lot of things happen. So I should take a step back. Natural gas is probably the hardest commodity to trade. It is the most volatile. It's known as the widowmaker. It's extraordinarily inelastic. And what we've seen is two things that the market missed. Everybody missed, except for the Monday morning quarterbacks on Twitter, who I jokingly refer to in private as the weathermen. The first thing we missed is that Europe has had an extraordinarily warm and benign weather, and good for them. They rolled the dice on the weather and they won. Bad for them if they take all the wrong lessons from that gamble, which we suspect they will. But if you pushed us, we would have said and did say back in September that we would be the first to cheer for a benign winter where the Europeans can slog their way through without significant suffering amongst their civilians. But the second thing in particular that Germany did that everybody missed was the speed and efficiency with which they brought back some 16 gigawatts of coal production, literally in the span of weeks, that everybody thought were significantly mothballed and not an option for them. Now, what that means is the price of coal, which we have been flagging for months, the Newcastle contract on an energy basis is trading for higher prices than oil, which is a really bizarre and unique situation, which screams stagflation to us. The Germans figured out how to get much, much, much more coal online, which means, by definition, especially because of the relatively warm weather, they were able to use much less gas than people thought they might need, which meant there was, of course, a decreased need for LNG exports. And on top of that, the Biden administration, who wants low natural gas in the U.S., again, trading against the Biden administration, has been slow rolling the Freeport LNG export terminals restart from the quote unquote explosion that happened several months ago. And so you have a lot of natural gas in the US that's stranded here. And even here in the US, we've had a relatively warm winter. We're going through a cold snap now in the Midwest, which will extend to the Northeast this weekend. And we'll keep an eye on the Northeast and see how much oil they have to burn to keep the lights on. But that's neither here nor there. I think natural gas, literally within a 5 or 6 month period, you have natural gas trading into twos in the US and natural gas touching $100 per million BTU in Europe. That is an incredibly difficult market to trade, to navigate, to hedge, to manage, to produce in. And it all, of course, stems from how difficult it is to handle and ship by pipeline or by LNG carrier the molecule, because it is a gas. The word gas in natural gas is the word that matters. And so, if we have an extended cold spell here, or if Europe does, and suddenly there's more demand again, and we begin exporting at our full export capacity, you could see those numbers flip. And by the way, we got to $10 per million BTU, not 8. You mentioned 8 earlier. I remember staring at $10 per million BTU on my chart back at the peak of the crisis. But as always, there are people who think that they can predict the weather, or at least retroactively take credit for having predicted the weather and saying that the crisis was all alarmism. I would argue that the $500 billion that Germany spent to get access to every BTU they could get, regardless of cost or carbon footprint, starving Pakistan of its natural gas, you name it, it worked so far. Knock on wood that it keeps working. Let's hope they don't learn all the wrong lessons. Let's hope they don't shut down the 3 remaining nuclear power plants this April. Let's hope that they don't get cocky going into the winter of 23-24, because they're just going to have to turn around and do this all over again. And if the weather cooperates again, great. If it doesn't, look out. I mean, it is fascinating to watch.
Yeah, for listeners who are not aware, you brought up some interesting points there. Germany spent around $500 billion in a very short amount of time, which is a very large percentage of their GDP, to stockpile energy for the winter. So it was a combination of coal, wood, liquefied natural gas. I believe I saw a number of different articles on oilprice.com back in August, September, October. The Chinese actually resold for enormous profits the liquefied natural gas that they got from the Russians, the either pipeline natural gas or LNG. They resold it back to the European Union and to Germany at enormously high prices. So they made a profit, and the Chinese are going to have to buy it back at some point. But there's a headline article on oilprice.com today talk about how German industry has to pay 40% more energy in 2023 compared to 2021. So these numbers, the amount of spending Germany did to bring in those energy imports in anticipation of a crisis, they just weren't prepared at all. Bad policy, bad investment. They were flat-footed. I saw another headline article, Doomberg, saying that they had to bring in a third floating liquefied natural gas facility. So they could have averted this crisis if they had the liquefied onshore liquefied natural gas import facilities and pipelines that were ready to go, besides just the Nord Stream ones from Gazprom.
Yeah, all of that is true. And imagine if the winter had been harsh and they had shut down their nuclear power plants, or they had not managed to get. Look, at one point when we published a piece a little earlier, Germany was getting 40% of its electricity from coal. Like, wow. This country has spent how many hundreds of billions of dollars on solar and wind, and yet, when they needed it most, they, as we said in the piece, they retreated back to the coal mines with the speed and efficiency of the British at Dunkirk. Like, it's just unbelievable and great. Like, kudos to them. But let's not pretend that this doesn't make a mockery of the ESG renewable energy movement. If Greta had gotten her way, and Germany had completely debased itself of all its nuclear power, and had not scrambled back to the coal mines in the manner in which they did, it would have been a catastrophe, even with the incredibly mild winter that we've had. Imagine if the weather had gone the other way. Again, they rolled the dice and they won. Congratulations. Don't learn all the wrong lessons. Unfortunately, judging at least by the tone of some of our European trolls on Twitter, we suspect that the exact wrong lessons will in fact be learned.
Yeah, I mean, they gave Norway and they gave Qatar and other liquefied natural gas exporters enormous amounts of business. And the Chinese took enormous profits, many billions in profits, just reselling the gas that they got from the Russians, or bought LNG tankers that they had already pre-booked. And then they just resold it for billions of dollars in quick profits.
Yeah, exactly. And so all of these things are true and interesting, but ultimately, again, you don't want to be in the camp cheering for cold weather, and we've never been in that camp. But we are in the camp of cheering for sane policy. And, so go ahead.
Well, what do you have for costs then for natural gas producers? Because if we stay at these levels for, 6 months, 9 months at the current U.S. natural gas futures contract price, those hedges are going to come off, and some of these natural gas producers are going to be in trouble, because it seems to me that the cost of production for a lot of these natural gas producers, it's going up. So even if they are oil producers with byproduct, I mean, there's a lot of producers out there, Doomberg, here in the US and Canada, that have a 50-50 mix or 60-40. They are either skewed 50-50 oil, natural gas, or they have 60-40 now natural gas, because of how natural gas has increased on a percentage basis the last 2.5 years.
I would say natural gas traded in the twos for the better part of several years. We still have lots of great natural gas producers in the U.S. They've been around this business a long time. They understand how to hedge. They understand the price elasticity of demand. I think they'll end up being okay. But of course, look, we're not trading these stocks, and so it's not something that we've given a whole lot of sort of analysis time to. But if you just go back and look historically, natural gas traded in the twos, even in the ones, for an extended period of time. I don't see this as existential.
That was the shale bubble, though. And I mean, like, that was like raising cheap equity from pension funds and like all the crazy games that were going on with private equity, right? So that wasn't that natural gas production growth, that shale gas bubble, that was all uneconomic for most of the producers while production was growing, wasn't it?
Sure. But then the market will correct itself, I guess is what I'm saying. There's enough need for natural gas. Look, for all our talk here today, natural gas in Europe is still selling for $18 per million BTU. There will be a global equilibrium price for natural gas. The band of that equilibrium price will be the width of the cost to ship it around the world. And the floor of that price will probably be much higher than $2.60 per million BTU. Where it trades on any particular day or at any particular part of the curve is interesting, but not particularly informative and or determinative, I guess is the word I'm looking for. I think the world will need clean energy. Natural gas is the cleanest of the fossil fuels. The world is desperate still for our natural gas. Eventually, the export terminals and import terminals to receive it will be built. And when they do, we will see BTU arbitrage in the long run. So what do I mean by BTU arbitrage? At $2.60 natural gas, you're basically talking about $15 a barrel oil on an energy equivalent basis. With oil trading at $80 and natural gas trading at 15 on an equivalent basis. This is not what I would call a permanent situation that I would be deeply worried about as sort of a long-term planner in the natural gas space.
Yeah, the global economy the global economy needs cheap electricity to operate, and I don't see any cheap electricity without more investments in nuclear power and also natural gas. So that means more.
Let's spin it positive. The American manufacturing sector is going to benefit greatly from $2.60 natural gas, right?
Yeah,
chemicals, fertilizers, any energy intense industry that is back integrated to natural gas in the US that gets to price its products on a global market is going to go through a boom in profit. So for every loser, there's a winner. These things are integrated and interconnected. And so I watched the price of natural gas go down by 75%, and I've seen all of the Monday morning quarterbacking going on Twitter. Those things are interesting to me. I observe them.
As a contrarian, I mean, it's very interesting. I see it as a potential buying opportunity the next 6 to 9 months because it looks like it's well below the production cost. So risk reward, it looks to me like similar to 2020, where you have the energy price below the production cost for a good chunk of the producers.
Yeah, and I mean, there's logic to what you said. I certainly wouldn't be in the world where we would give investment advice. The last vertical where we would give it is in the natural gas space, given all of the peculiarities of that market that I described earlier. But having said that, hard to see. Like, I don't think natural gas is going to go negative for any extended period of time. I mean, it does occasionally in certain regions where you literally need to get rid of it. But even then, those things are short lived. So yeah, but at the same time, I would be, if I had a marginal dollar to invest, I would be looking at companies who would benefit from low natural gas, as opposed to betting on the commodity itself. But that's just me and my risk tolerance.
And a lot of the research for natural gas demand and liquefied natural gas, I mean, there's a lot of long-term demand for this. So in the short term, it could go lower. It could stay at these levels for a while. The higher cost producers with debt on their balance sheet who weren't hedged at 6 or 7, those guys could go bankrupt or get bought out for pennies on the dollar. I mean, there was already a lot of mergers and acquisitions in the natural gas industry. I think EQT and others just made a bunch of big acquisitions the last 6 to 8 months. So we could see more of that. So if the price stays low, we could see an accelerated amount of mergers and acquisitions then.
Yeah, again, there's what is the value of the equity stack in any particular natural gas producer's capital table versus what is the inherent value of their claims and their assets and their know-how and their expertise relative to the debts they owe. And those things tend to get worked out over time. Again, since we don't do individual company investment, It's not something we spend a whole lot of time thinking about, but this too shall pass. Natural gas is a valuable product. The product traded for $100 a million BTU in Europe this year. Like there is a need for it in the world, and nothing like an arbitrage. Even today, again, like we talked about, the ratio of the price of natural gas in Europe to the price of natural gas in the US is actually relatively unchanged. It's been around 6 to 8 for several months. It's a chart I'll have to pull up again when we get off to look at. But I know intuitively it's trading for 18 in Europe and under 3 in the US, so it's probably sitting at 7 again. That's a significant arbitrage ratio. Capitalism works. Investments will be made. That will close. And the world will be better off for it because then we will have natural gas more as a global commodity as opposed to a regional one like we have today.
And the Chinese also have to rebuy all of that natural gas and liquefied natural gas that they resold to Europe at enormous profits over the last 3 to 5 months.
Oh, they might. I mean, they also are re-engaging Australia for coal. Again, one of the things we learned, especially with the German experience, is, and especially with coal trading for a higher price in oil on an energy content basis, that when push comes to shove, when it's catastrophe or pollution, the economies will choose pollution. And so this probably doesn't come as a surprise to people, but China has gotten over its sort of unspoken diplomatic war with Australia. It is beginning to buy Australian coal again. You know, they will perhaps not have to rebuy that natural gas and will just displace it with coal. And consequences to global warming be damned. They don't care. Xi Jinping doesn't care about carbon emissions. That's a luxury of the West.
Well, China's supposed to open up a bunch of nuclear power plants in the decades to come, but things were delayed for years because of Fukushima. I think they had to redo a lot of the security measures.
From what we read, they have 150 nuclear reactors in various stages of design and or construction, with upwards of 50 of them being built now. But that's years out, of course. And so what natural gas does in the next 12 months won't be too impacted by Chinese nuclear ambitions. But India, Russian gas finding its way to the market via other means. The war in Ukraine basically disrupted supply chains. It hasn't really stopped a significant amount of energy from finding its way to the market, thankfully.
Has anything on the fertilizer supply improved? Have the fertilizer export bans been lifted yet that started with back in February with Russia and then Brazil? Have the fertilizer export bans been lifted yet?
I mean, all of this stuff ends up going through various black market channels, which is one thing we've learned from the Ukraine situation, is valuable commodities, when they are, quote, banned, or when governments like the G7 try to put price caps on them, or pick your favorite central planning control mechanism, all you really need to circumvent that are middlemen willing to break the law. And there's no shortage of those in the world. And so I would say the best thing to happen to fertilizer is the crash of natural gas prices. And we shall see. I was literally just at a conference full of large farm owners, and most of them feel pretty good about their access to nitrogen for this year. Some pre-bought, some hedged, some waited for the prices to come down. These families manage their farms over decades, and they've seen booms and busts come and have a pretty good sense on how to manage it.
So since
now, what that says about the hand-to-mouth farm producer in different parts of the world, different story. Sorry.
So since you were just at a conference with farmers, I'm curious your thoughts on the egg shortage and the prices on eggs and the chickens that are dying.
Yeah. So when you are cutting it close on supply, every little upset in the supply chain has an amplified impact. So, I mean, I saw a tweet the other day which made me laugh out loud, which said, back in the day, I was so wealthy, we egged people's houses and TP'd their trees on Halloween. Yeah, and now you can't find toilet paper or eggs. But I and then I see the reports of various food production facilities catching fire and people wondering whether this isn't all on purpose. I think when you run plants hard during shortages and you postpone maintenance and labor's in short supply and new employees are in there, that sometimes you just have accidents, and it's hard to tell what's a pattern versus what is noise. I'm a prepper. I'm not yet worried about sustained food supply shortages in the U.S. This late winter and into spring. based on the reports that I've seen about the so-called egg shortage. The price of eggs, a dozen eggs is what, $5 now, somewhere $6. 50 cents an egg, that's an awful lot of food and protein. Considering I just paid $24 for 3 bottles of water and a cup of coffee. So I get it's important to put things in perspective as well.
Yeah, it also depends which area you live. So
yeah, 100%.
So the supply chain, the cost of eggs are even higher than what you just said in certain areas.
Sure, I don't doubt that, but that we saw that with lots of different supply chain crises. I did see, of course, there were the reports of all of this this disease making its way through the chicken population in the U.S. And so, of course, with a lag, now we're seeing it show up in the price of eggs. I don't think it's a systemic issue or something that foretells a bigger crisis down the road. Let's put it that way. I could be wrong. I hope I'm right, but I could be wrong.
Well, it's going to work its way through the restaurant supply chain. So you're going to see shrinkflation and higher prices for things like flour, bread, pasta, the pizza dough. All these things are going to be affected by egg prices.
Yeah, no question. No question.
So we discussed a lot of, I would say, not so optimistic things. I've been asking my guests about this. Is there anything that you're actually optimistic about long term?
Yeah, again, I would go back to the fact that North America, Canada, and the US in particular, have an abundance of cheap, clean natural gas. And our manufacturing sectors that are 1 and 2 steps downstream from natural gas are going to be extraordinarily well positioned to compete on a global scale, which is what we need if we're going to start making stuff again. And so I would say that the collapse in natural gas price, while it might be a challenge for natural gas producers, is a boon for the next leg down in supply chain, and there's more of those than there are natural gas producers. So I think if we are smart and we take advantage of our relative energy bounty to learn how to make stuff again, we could have a far shallower or even skip a recession compared to what the rest of the world will probably see, and the U.S. might be in pretty good shape coming out of it. So I'm optimistic for producers who make stuff that they could sell at global prices, but pay for their energy costs locally, because right now, the U.S. competitive advantage is pronounced.
Oh, those are good points. So the U.S. manufacturing, U.S. food production will all benefit from a cheaper relative advantage for energy prices then.
100%. That's what I would leave you with.
I think this might come as a surprise to a lot of people, but with these higher interest rates, I think like a lot of the waste, fraud, corruption, and abuse from these Silicon Valley companies, these unprofitable companies that were getting away with creating their own accounting metrics, I think we're going to get back to fundamentals. We're going to get back to looking at running companies efficiently, because capital is going to be so expensive. It's not going to be cheap and plentiful, and all you have to do is invent your own accounting metrics and grow revenues, and you could just sell more shares to suckers. So we're going to get back to running companies a lot more efficiently going forward. As well, assumes that the Fed doesn't immediately start slashing interest rates and go to QE immediately and do a 180 very quickly and expanding its balance sheet.
Yeah, I concur with all of that, and I don't think the Fed will. And I do think if you're a business that requires fresh injections of fiat in order to keep the plate spinning, we're going to be having the mother of all Greek weddings here in the next 12 months with lots of plates hitting the floor.
Yeah, I think we're going to see a lot of bankruptcies that are going to surprise people from a financial history perspective. When the interest rates do increase at this pace, whether it's inflation or deflation, you start to see a lot of bankruptcies from different companies in different sectors. Just because the interest payments on the debt, if they had too much debt on their balance sheet, because the corporate company CFOs and the senior executives decided that they wanted to, while interest rates were cheap, load the debt with a lot of variable interest rate on their balance sheet. And now at higher interest rates, the interest payments on the debt are going to be onerous as well. So I think that's going to cause a lot of problems for a lot of companies, different sectors. It's not priced in yet. I don't know what's going to happen with the stock market, but I can tell you that if a company has a lot of debt on the balance sheet and it's not locked in at a fixed rate, that's going to suffer. Same thing with real estate too, at these interest rates.
Yeah, all I think quickly becoming common knowledge. So we'll see how it plays out.
The last thing I want to say that's actually optimistic, and we touched on this a little bit, is that maybe it's just the Oliver Stone documentary that was shown at Davos and starting to interest people, that all these countries, whether it's China, Japan, Germany, because they've gotten killed with their energy input costs and it screwed up their trade balances. So they're not able to run enormous trade surpluses because they're importing so much energy. This just a enormously large unexpected cost. They got hit with a very, very large bill. So now they're starting to look at, well, how do we lock in a long-term cheap electricity rate? And they're starting to talk about nuclear power again.
Yeah, I agree. And there's still pockets of idiocy in the world that will have to be dealt with. But by and large, I think the green shoots of logic that we've seen in the nuclear space, be it Canada with Pickering or California with Diablo Canyon or Japan reuniting with nuclear or China building it out and India building it out, and SMR is being approved. There is still the thorny issue of the nuclear, the NRC to be dealt with, which is a piece we're working on. But by and large, I think there are tailwinds to the nuclear sector. It's ultimately the only truly viable solution to at least partially decarbonize our economy. And the sooner we recognize that, the better. And that is indeed, I would say, a wonderful way to close on an optimistic note.
Yeah, I just wish there was more money by these governments spent on research and development for next generation nuclear power, some of these small modular reactors. I'm a big fan of the liquid fluoride molten salt thorium reactor because once the pilot plants are tested, I mean, this can recycle those old nuclear power plant fuel rods. It can recycle all the old nuclear weapons that were stockpiled, the missile warheads. So it can recycle those things. And then I think like the amount of waste is only about 100 years or so.
Yeah, there are no significant technical challenges to doing this. This is a political issue, full stop. And so if we have the politics, we can get it done. There are all manner of technical solutions. It's not even a financial barrier. All of the sort of financial costs are driven by obscene regulations and lawsuits and all the things we talked about earlier. So in the end, we can solve this problem. It's just a matter of politics. And when the pain gets high enough, like you observe, maybe the politics gets some clarity. So yeah, I agree.
Yeah, for examples there about how bad the politics, rules, regulations, red tape are just to get the permitting and the fees for a nuclear power plant in the United States, you're looking at over a decade and $20 million, give or take, in permitting fees. So that's before you spend over $1 billion on actually building a nuclear power plant that could take 10, 15, 20 years of construction.
Yeah, I agree.
Yeah, so it's not an efficient process, unfortunately. The free market's not, it's not something the free market's involved in. I mean, there's so many different government regulatory agencies, the Department of Energy, I think the nuclear regulatory, there's all these different regulatory agencies that take enormous amounts of time with permitting and fees.
Yeah, this is ultra 100%.
Yeah, so I hope if nuclear power is going to be a growth engine, that these things will be fixed. But unfortunately, I live right outside of Washington, D.C., and the Department of Energy is a piggy bank for Congress with a lot of waste, fraud, corruption, and abuse. So I don't think in the short term it's going to get fixed.
No, we'll see. I mean, politics can change. It'll win. Let's hope it does.
Well, look at some of these other countries. I mean, look at all the bills that they've gotten for the energy imports, how much money Germany just spent. Japan was not running trade surpluses anymore because of how much raw energy they had to import, whether that was coal, liquefied natural gas, other forms of hydrocarbons. So they're going to have to come up with a long-term solution. And it looks to me the best one right now is nuclear power.
Yep. This is, again, a point we've been making for a long time. And whether they get there or not, time will tell. But this is the ultimate answer. And the sooner they get there, the better, for sure.
So do you think then the economy alternating between inflation, deflation, the governments and central banks pulling all these levers, doing all these policies, this is going to prevent a lot of key investments from a lot of these commodities on the supply side for the foreseeable future then?
Well, no, I just don't think they have the desire to. They're happy to take their dividends and do their stock buyback and to blame the defund fossil fuel movements. And I think they have the cover to monetize, and they will. So again, that is the big change in this commodity cycle. We have not seen the massive overspend, and so we're not going to see the onslaught of supply, which creates a glut, which reduces prices that we have seen historically. So I don't see it.
Well, the oil and natural gas companies are the ones with the big profits that you said, but a lot of these other commodities, say the miners, the base metal miners, the gold miners, they did not have enormous profits for a long period of time. So they didn't have all this other free cash flow. And if you're a regular mining company for a base metal or precious metal, I mean, your energy input costs, your diesel, your electricity, your chemical costs, raw materials to build a mine, your labor costs, all these things are up. So really, it's just been the oil and natural gas companies on a when you're looking at all the relative to all these other commodity companies that have had the big profits the last 18 to 24 months.
And all those things feed those other industries. And so, yeah, again, we didn't talk about mining yet, but I'm not bullish on miners as a general rule. I think it's pretty crappy business with highly variable input costs and highly variable prices. They're price takers. And so, yeah, I don't see, and again, that's why I don't think that we'll see the metals we need to affect the so-called green transition anytime soon. So, yeah, 100%.
Yeah, I agree on that. I think we're going to see a copper problems in the next 10, 15, 20 years because a lot of the copper mines that have been running for a long time, I mean, we're below 1% copper grades for a lot of those old copper mines. They've been depleted that much.
Yeah, of course. Yeah, this is all widely understood, except by policymakers who are mandating the shift to EVs, while simultaneously working to oppose the updating of electricity grid that will need to charge them. So, in the end, this can't go on.
Yeah, it's hilarious. I actually have a funny anecdotal story that electric vehicle company in China actually went to a gold company, a gold and copper company in Vancouver, and was giving them a pitch on electric vehicle demand, and they just assumed that all the copper is easily going to be able to easily buy with futures contracts.
Yeah, again, that's financialization. You can't wish copper to appear. You have to go and mine it.
Well, I guess it's a function of price then. So if we're going to be looking at what $8, $10 a pound copper instead of $2 or $3 a pound copper, I mean that will open up a lot more supply. But then the age of cheap metal and cheap electricity, we're going to have to get more efficient then at recycling things out of the junkyard or making actual products. Like Apple is not good at this, making actual consumer products, the electronics that are a lot easier to recycle.
Yeah, recycling is certainly going to be bullish, but even there, that requires a lot of energy because you're talking about sort of low entropy resources distributed across the economy that you have to aggregate in one place and then purify and separate and all those challenges. And that's not a free lunch either. But for sure, that which can't go on forever usually doesn't. And we don't anticipate that the current trend will go on forever.
And on your Substack,
sorry, yeah, go ahead.
Well, I was going to say on your Substack, your newest article is about mining on the ocean floor. I mean, as far as I know, governments aren't even going to allow it. I mean, the permitting is almost impossible.
Well, that's a whole other ball of wax that we probably don't have time to get into. But the international management of deep sea mining is, I would call it sort of the equivalent of the FIFA soccer. Like there's all kinds of opportunities to bribe. Environmentalists will bribe to shut it down, and mining companies will bribe to open it up. And we shall see. There's a big decision to be made here in about the next 6 months, where ultimately the controlling body, the sponsored by the United Nations, will have to decide on whether to issue permits and how to go about it. But again, that's probably it's a lot to unpack in a short period of time. But for sure, it's not going to be as straightforward as the proponents of deep sea mining think. Which, again, in the piece we published today called "Sunken Treasure," this is destined to be a cash incinerator and not a panacea.
Yeah, I remember Nautilus Minerals. I mean, they had an interesting business plan. They had investments from 3 or 4 of the largest mining companies in the world, and that company went bankrupt because their permits, they could never get the permits, even though the grades on the ocean floor, I think it was Papua New Guinea, but there were other grades, the samplings of the grades, there was insanely high grades of gold, silver, and copper on the ocean floor where they wanted to mine, but they weren't going to get the permit. So basically the company went bankrupt.
Yeah, it was a 10-year odyssey, and I don't believe those grades, if I'm being honest with you. I think there's a lot of, as you know, the junior mining sector, and I would lump deep sea mining along with it, is rife with a lot of, let's say, questionable activities, and it destroys a lot of capital. But the Nautilus example, again, after we published our piece this morning, a subscriber sent his personal experience with that particular investment. We spent an hour looking into it this afternoon. It's quite the story, and a lot of capital was destroyed for sure.
That's interesting. So you're saying that the large mining companies that made those big equity investments initially also got suckered?
Who knows? I mean, sometimes sometimes big companies make investments for all kinds of reasons. And getting in the headline of the day, showing your shareholders that you're doing something, that you're not ignoring various trends. Big companies get swindled all the time. Look at all the people that were backing Nikola before we found out that Trevor Milton rolled a truck down a hill. You had some of the biggest names in the auto sector, including General Motors. So I would say that the presence of big names in a capital table is interesting, but not determinative.
Yeah, normally it's done for marketing. So if the executives, the senior executives of the little company can fool the big company, then they can bring in even more capital. So they spend a lot of extra time trying to sucker the big companies.
Yeah, exactly. So I wouldn't read too much into that either way, to be honest.
Yeah, I mean, FTX did the same thing. I mean, he was using celebrities, he was getting big company endorsements. Okay, well, I want to thank you so much for your time, and I'll attach a link to Substack. And if my listeners want to check out your work, how do they do so?
Yeah, it's Doomberg, not Bloomberg. So don't go to Bloomberg. Go to doomberg.substack.com. And we write 6 to 8 pieces a month, 100% subscriber supported. Appreciated the conversation today and looking forward to coming back.
Excellent. Well, thanks again for your time. And there's always going to be a lot to talk about because I think, unfortunately, the policy blunders are going to continue going forward, although it does look like more people are starting to open up to nuclear power.
100%. 100%. Appreciate it, Jason.